What is up, guys, and welcome to Lecture 4 of the TCT Mentorship, where I'm going to be teaching you everything that you need to know about liquidity. And this is the last lecture going over the basics and the foundation that you need to understand and master in order to trade TCT schematics in the correct way. And this is the last one, but in my opinion, the most important, okay? Because we trade and TCT's concepts are built around the understanding of market makers. But if you want to understand market makers, you need to understand liquidity because that's what market makers need in order to move price, okay? Which will all be clear in this mentorship. So pay close attention, okay? After this lecture, we're going to get into the juicy stuff of the strategies built around all the knowledge I've just given you guys in the past 4 lectures. But what is liquidity? When I am talking about liquidity, I am mostly referring to where the most stop losses are located. Because what you guys need to understand is, let's say you go long, okay? Right here we have an uptrend, we have a higher low and a higher high, and you enter right here on this break of structure. You go long, okay? Meaning you buy. So you buy right here, and let's say your buy order is worth $100. Okay, now you put your stop loss below the low and you target somewhere higher. And what happens when your stop loss gets hit? Unfortunately, you buy, but your stop loss gets hit. What the exchange will do that you're trading on, it will sell your position at a lower price. So you buy right here for $100, and then when your stop loss gets hit, it will sell that position back to the markets at a lower price, meaning you will have a loss. But they sell it back, okay? You have a buy order, the stop loss gets hit, you sell it back to the markets at a lower price for a loss. It works the opposite way when you go short. Let's say we're in a downtrend and you enter on the break of structure. Well, you put your stop loss above that market structure high and you target somewhere lower, okay? Unfortunately, the stop loss gets hit. When you enter, it means you sell. You sell $100, hoping you can buy it back at a lower price for a profit. But if your stop loss gets hit, it means that the exchange will buy back the position at a higher price for a loss, right? But this is crucial to understand. When you go long and your stop loss gets hit, it means you sell back the position at a lower price. And then when you go short and your stop loss gets hit, it means you buy back the position at a higher price. And the reason why this is so important to understand is because TCT schematics are built around the understanding of market makers. Market makers move price. If you are in a trading position and you want that position to hit its take profit, you are depending on the market maker to move it in your desired direction. Because us as a retail trader, we cannot move price. Our position sizes are too little to be able to move price. So if you want your take profit to be hit, it means you hope that the market maker will move the trade in your desired direction. Okay? But a market maker can only move price with enough money. Sometimes even hundreds of millions up to billions of dollars in positions to be able to move price when you're trading very liquid assets like gold, Forex, but also BTC, which is $1 trillion asset class, right? You need lots and lots and lots of money to be able to move price. However, if they want to move price, meaning they'll have to buy hundreds of millions of dollars of BTC, well, for every buy order that the market maker wants to fill, they need an equal order selling it to them. If I want to buy 100 million, someone needs to sell 100 million to me. Otherwise, I cannot buy 100 million. So what do the market makers do? They will look for areas where there's the most liquidity, meaning the most stop losses. Because you know, if your stop loss gets triggered, that causes either a buy order or a sell order, depending on if you are long or short. Right? And then they search for those areas of liquidity to fill their own positions, and then they can let price reverse. So what you can see right here in the picture is that, let's say we have a range high, okay? Let's say we have a range high and we have a range low and we have a few local highs right here, just a few local lower highs. price only went down here if there were sellers. Well, people went short, causing price to go lower. They put their stop loss above that high, okay? That's the clear invalidation. Same goes for this high, same goes for that high. If that stop loss gets hit, that causes a buy order, a buy trigger. They are short, so they sell the position to the market. If their stop loss gets hit, it means they buy the position back at a higher price. The 10 and the 20 and the 15 represent millions, okay? So above this high, there are stop losses located worth 10 million in buy orders, okay? So if price comes above that high, stop losses will get hit, causing a 10 million buy trigger. For this high, it's 20 million, and for that high, it's 15 million. The market maker will realize that using his data, and they'll see like, okay, I want the dump price. I want the dump price, and the price is right there. I want the dump price lower, okay, aggressively. And he calculates, okay, I need 45 million, a bit more than 45 million to dump price. He cannot fill 45 million right here because there are not 45 million people buying it of his sell orders. So what he'll do is he'll push price ever so slightly, causing these stop loss orders to get triggered, causing 45 million in buy orders, which is the perfect amount for his $45 million short position to get filled, because now he has 45 million people buying it to him, or buying it off of him so he can sell it to them, and then he'll add a few million to cause the dump down. But that's how he fills a $45 million short position. He'll look where the stop losses are that equal the amount that he needs to sell in order to dump price. He'll let price ever go up ever so slightly. When this stop loss gets hit, that causes that buy trigger, so price spikes higher, and then that causes that stop loss to get hit, causing a spike higher. Now, all these stop losses are getting hit, equaling a $45 million buy order, so he can sell 45 million to the market now. And then let price reverse, because markets love to move from liquidity to liquidity, especially in crypto. Crypto is a bit less liquid than gold or Forex. So markets need liquidity to be able to move. So in crypto, you'll see it way more often that price will literally just go from liquidity point to liquidity point. And all the liquidity points will be explained later in this lecture, okay? And when we want to go long and we want to pump price, it works the exact same way, right? Let's say the market maker comes to the market right here, and he's like, okay, I want to pump price. But in able to pump price, I need 100 million buys. But if I want to buy 100 million, I need 100 million people or 100 million getting sold to me. It doesn't have to be 100 million people. Just the position size needs to be 100 million. He'll see that below each low, people bought right here, causing price to go up. People buy. They put their stop loss below the low. If you take out that low, it will cause a 20 million sell order, because when you are long, you buy, and if your stop loss gets hit, you sell at a lower price for a loss. So all these lows have stop losses causing a sell order. So if Mr. Market Maker comes to the markets and he's like, okay, I need 100 million to be able to pump price in my desired direction, okay? What he can do is move price down ever so slightly, just so this stop loss gets hit. That will cause a 20 million sell order. That will hit that low, cause a 15 million sell order. That will hit that low, causing a 30 million sell order. Now he has 100 million sell orders, so he can buy 100 million. And then reverse price, adding a few extra to the next liquidity point. It's very nasty, guys, because if you do not understand it, he is taking your stop loss to fill his position and then reverse price in your desired direction. So if you ever had the feeling that your stop loss is a target, it literally is. If you go short, your stop loss gets hit, and then price goes into your favor, hitting your take profit, it's because you're on the wrong side of the market and you do not understand the market maker properly, because he's using your stop loss as liquidity for his own good. Okay? So let's talk about where the most liquidity will always be located. So, talking about location of where will always be the most liquidity. It's very simple. When you're in a range, the most liquidity will always be above your range high and below your range low. Why? Because people that sell in your range, hopefully they are selling in the upper section of the range. The most clear invalidation is the range high. they go short right here, and they're like, okay, if price goes above that range high, that's my invalidation. So your range high and your range low will always have the most liquidity. Furthermore, we also have structure. When we're trending up, your market structure low will always contain the most liquidity. Why? If people enter on the breakout structure, they'll put their stop loss below the low, right? People enter on the breakout structure, they put their stop loss below the low. Sometimes people even trill their stop losses, meaning it's double the amount on their one low. But when people buy, they put their stop loss normally below the market structure low, which is very normal to do. So the market structure low in the uptrend will always have the most liquidity. Your market structure high also has liquidity in an uptrend, but it already gets taken on each break. When we're trending down, your market structure high always has the most liquidity. Why? Well, people go short right here, and then the moment this low gets touched, they'll trill their stop loss to this high, then they'll enter right there, or enter more on this break, put their stop loss below that high, enter more on this break, put their stop loss more above that high, and sometimes they even trill, right? So once you have an extra break, they'll move their stop loss lower, like this. So in a downtrend, your market structure high will always have the most liquidity, okay? Now, already knowing this, already knowing just the information I gave you guys, you can look at the ranges and the market structure points and, the supply and demand I've all taught you in a completely different way. Because let's look at range deviations now. Okay, let's look at range deviations. We've talked about range and we've talked about market structure, right? What we see right here is we see an uptrend. Okay, what we see right here is we see an uptrend. And then we have our range high, we have our range low. And it's confirmed right here when we touch that AQ. That's not on the chart right now. We know that our range high has the most buy side liquidity. Meaning, if that high gets taken, the stop losses will get triggered above that high, causing a buy trigger. And that's why we call it buy side liquidity. Same when this stop loss gets hit, the stop loss around the range low, they will cause a sell order, a sell trigger. That's why it's sell side liquidity. Now, if Mr. Market Maker looks at this range and he wants to dump price, well, what will he do? He will push price just above that range high, keep it in the DL, the deviation limit, okay? Make price go lower and reverse it to the range low because markets love to move from liquidity to liquidity. Price will go up above our range high, and it will have a double effect. All the buy side liquidity will get taken, making the Mr. Market Maker able to fill all his short positions. But at the same time, you have people longing the breakup structure, or people trying to long the higher low because they think it's a breakup structure because they don't understand ranges and the DL limit, right? So taking that range high gave the Mr. Market Maker the ability to fill all his short positions by taking that buy side liquidity. At the same time, people will try to long the higher low and their stop loss will get hit. Well, what happens when the stop loss gets hit of a buy order? The exchange will sell it to the market, which will just add extra fuel to the fire when we're going down, right? Because it will sell and the market maker is already short, and then all the stop loss gets hit, causing sell triggers, and it will be one massive cascade down to, guess what? The next liquidity point, because markets move from liquidity to liquidity. So when you are looking at the markets, I don't want you guys to think from a simple perspective of, oh no, we have a higher low and a higher high, I'm just going to long the higher low now. No, I immediately want you guys to think of, hey, we have a range, we have a break, but it falls in the DL limit. This gave the market maker the opportunity to fill all his short positions. If we get acceptance back inside the range, that could mean a reversal back down to the next liquidity point. That's how I want you guys to think, okay? Because that's what is actually going on. And if you do not think like that, you will get trapped. You are the one getting trapped. So instead of just thinking, oh, we have an uptrend, we have a higher low and a higher high, always check the DL too. See if it's a breakup structure or a potential deviation. And then price can have acceptance back inside the range, which is something regarding TCT's concepts, which is going to be more clear in the next videos, okay? And then price could potentially have a rotation all the way back down to the range low, because guess what? That is the most obvious next liquidity point, because the most obvious liquidity points in the range are the range high and the range low. Okay? So that is actually what is going on. And the same goes for an SFP. Did you guys remember when I talked about wicking your market structure high and wicking your market structure low, and you potentially having a rotation to the opposite market structure point? So if you wick your low, you can have a rotation to the high, or when you wick the high, you can have a rotation to the low. It's based around liquidity. It's based around liquidity. Because let's say we're trending up. Let's say we're trending up and you're paying attention to that overlapping structure and you enter on that red break of structure, thinking about the domino effect, about, hey, that could mean we could have a rotation back up towards the black high, and from there we can have a continuation going higher, and you go long. Like I said, it's very normal to put your stop loss below that market structure low. That's completely normal to do. But what the market maker could do is he could dump price lower and then wick your market structure low, right? Now, I told you guys, when you have a wick, you can have a rotation back towards your market structure high because a wick is not a market structure break. But what will happen, now that you also understand liquidity, it has the confluence of, hey, we grabbed all sell side liquidity, yeah, because this is a stop loss from a buy trade, meaning the market will sell it, or the exchange will sell it back to the markets, causing it to be sell side liquidity. That gave the market maker the opportunity to fill his buy orders and make price reverse. That's why when I talk about SFPs potentially having a reversal to the opposite point is a thing. Because the market maker saw that market structure low. He knows that while trending, the most obvious liquidity points are market structure highs and market structure lows. So he can make price go past that market structure low, wicked, causing sell side liquidity to be taken, so he can fill his buy positions and make price reverse. It's so tricky, guys, because the average trader that doesn't understand smart money concepts in the way that we do over here, they're getting destroyed left and right. They're absolutely getting destroyed. Absolutely getting destroyed. So, am I missing something? No, we're all good to go. So it's crucial that you guys understand this, right? Because that's, like I just said regarding ranges, that's how I want you to switch your mindset of like, hey, we just took that low. That gave Mr. Market Maker the opportunity to fill his positions and reverse price. That's what I want you guys to think each time you see a break or a deviation, especially a deviation, which you can always check with the DL tool, right? Because my name, guys, is the Composite Trader. Why is my name the Composite Trader? The guy that created Wyckoff, his last name was Wyckoff. And what he said in his book, right? I haven't read his book, but I saw a quote from it. And he said, I want you guys to look at the markets as if it was controlled by one man. And let's call him the Composite Man. So what I call the market maker, he called the Composite Man. And when you understand the Composite Man, you will always be victorious. That's why I am the Composite Trader, because I understand the Composite Man. I understand the market makers and what they're actually trying to do. Okay? So, besides our market structure highs and our market structure lows and our range highs and our range lows as liquidity points, we also have something called trendline liquidity and liquidity curves. And for the people that have been following me and don't just know me from this mentorship, you guys have been seeing me draw liquidity curves literally all the time. That's literally what I draw all the time. But now that you guys understand liquidity, right? And you understand market makers, I want you guys to ask yourself, why do trend lines not work? They can work sometimes, but oftentimes trend lines do not work. And I'm already, showing you guys a bit what the answer can be, but really ask yourself, trend lines are one of the most common patterns used in the trading world. And because it's so known and used, it doesn't work good. But I want you guys to ask yourself now, thinking from a market maker perspective, why would a trend line not work good most of the time? Okay, if you thought about it, The answer is a market maker always looks for points where there is the most liquidity, right? And trendline is such a common used pattern where every retail trader that just enters the market has seen a YouTube video about the trend line and is like, hey, we have all these highs connecting right here on this trend line, and I'm going to short the lower high because that's what they are taught. That's what they are taught. They're going to short this red structure. They're going to short the lower high. That's what they think because we have this trend line. At the same time, all the people that have already shorted the trend line will probably put their stop loss above the previous high. And the people that shorted here will put their stop loss above the previous high. And the people that shorted here will put the stop loss above the previous high. So this trend line is basically just stop loss here, stop loss there, stop loss there, stop loss there, stop loss there. And market maker knows that you are trying, as the average trader, to short that lower high, right? So when the market maker comes to the market and he sees a trend line, he just sees liquidity. Because he thinks to himself, hey, I want to dump this market down, okay? But in order for me to dump it and be positioned in a good way, I need 100 million sell orders. Well, he knows all the people that shorted this trend line have stop losses that are causing buy orders, buy side liquidity. So what he will do, right? What he will do is he will take out all these trend line highs, which will trigger all the buy orders so he can sell 100 million. That's what the market maker sees when he sees a trend line. The retail person will see this. The market maker will see this. And I want you guys to see it like this. So when you see a trend line, don't try and short the lower high. Watch and if the highs can get taken, causing those stop losses to get triggered, causing the spike up, causing all the buy orders so he can sell. Okay? So when you have highs that are all connected on the trend line, I call it trend line liquidity. I'm not even looking at it to long or to short the bounce of a trend line. I'm looking for the trend line liquidity to get taken. Completely different mindset than most traders, right? And the same goes with liquidity curves, okay? The same goes with liquidity curves. So when I have a liquidity curve, okay, it's simply when price is, for example, trending up right here or trending down, but it's trending up sharper and sharper, so the lows will not be connected with the trend line. It's impossible to connect the lows with the trend line because it's curving up sharper and sharper. So I cannot connect it properly on the trend line. That's why it's a curve. It's curving up, okay? And when we're trending down and the lows are getting deeper and deeper, and you cannot connect them with the trend line, it's curving down. Hence the name liquidity curve. So people, that long right here will put their stop loss below this low. Okay? People that long right here will put their stop loss below that low. Because that's the generalized concept. You long a higher low, you put your stop loss below the previous low. And people that long right here will put their stop loss below this low. And people that long the breakout will put their stop loss below that low. So all these lows have stop losses, and it's curving up. The only extra requirement you need to have in order to call it a good liquidity curve is you do not want any demand on each higher low. You want each higher low to mitigate all the demand that there is. Because I've been teaching you guys about demand, right? Demand is basically an indication of where the market maker stepped in and pushed price higher. Because you have an order block or you have structure demand. But you guys know now that the only people that can move the markets are market makers. So when you have demand, that just means that the market maker pushed price higher there, okay? And then when price comes back to that area, they can protect their positions. That's something you don't want, okay? That's something you don't want. You want each low, okay, to just have pure liquidity, pure stop losses, and no demand backing the low up. You want no demand in this curve, okay? So the liquidity curve is basically when we're trending up, each high is a bit higher up, so you cannot connect them with the trend line, but you have a curve that has no demand, okay? No good demand. Now, when we're obviously curving down, the same thing applies. All these lows or all these highs are lower than the previous one, causing them to have stop losses all over the place here of people shorting, right? And you want no supply backing up the high. No supply backing up the high. Okay? So what a market maker sees when he comes to the market is like, hey, if I push price down ever so slightly and all these stop losses get triggered, it will be massive sell side liquidity, making me able to fill my buy orders and potentially let price reverse from there. And when he sees this, when he comes to the market and he wants to dump the market properly and position himself in a good way, he will push price up ever so slightly so all the stop losses get hit, which will be buy side liquidity, so he can fill his short positions and then dump price down. Okay? It's for me at this stage in my trading career, it's so obvious. But when you learn the most basic patterns on YouTube regarding trading, this is such an eye-opener. It's looking at it in the complete opposite way, which is exactly what you need to do, because you need to be on the other side of the market, because on the other side is the market maker. You have the market maker and you have us. And you want to be on the side of the market maker, not on the side of us in general. You know, we are doing it good over here on TCT trading, but the trading pattern gurus are having a harder time, okay? And there can be patterns that work decent, okay? You can make your own concept around it and make it profitable and execute like a robot and be good, but in general, the patterns that are very known don't work good, okay? All the bull flags, I don't know, diamond patterns, falling wedges, you name it, okay? So I've shown you guys about, trendline liquidity curves, liquidity above range high and range lows, and how a deviation actually goes into work, of, hey, we're taking the high, we grabbed all the liquidity, now we can go to liquidity below, because we know markets love to move from liquidity to liquidity. We can also use liquidity from a different perspective, making it have another purpose, okay? And that's something called the return to zone. The return to zone. So, return to zone is looking at liquidity in a bit of a different way, okay? What you see right here is a TCT Model 1 distribution and a TCT Model 2 accumulation, okay? And you do not have to understand this yet, okay? Especially if you're new. This is something we're going to get into the next lectures. All the juicy stuff, right, is going to get into the next lectures, or other strategies around the concepts you have been taught in lecture 1 till 4. Understanding TCT, you will know that you can probably short right around this red dot, okay? And you can target the range low right here. Now, the return to zone basically means that we have a very, very, very easy way of going down to our target. Our return to zone is extremely good. Why? If we get our short confirmation based on a TCT schematic, the target of the short will always be the opposite range point, which is something you will learn in the later lectures. However, if from the low up, from this low up towards our short confirmation entry, there is nothing but liquidity, therefore also no demand, because in order to have a good liquidity curve, you need no demand, it will give us an extra confirmation for the short, because one, there will be nothing to hold price up, right? There will be nothing to hold price up from a demand perspective, and if that first stop loss gets hit, which will probably be below this low, that will cause a sell trigger. And that sell trigger will spike price down a bit lower, causing that next low to get mitigated, okay? And those stop losses to get tapped, causing another sell trigger that will spike price down even more to this low, and that low, and that low, and it will be a snowball effect, where that first order getting hit will spike price down to that order, and then you have a cascade down of sell pressure, basically just by stop losses getting hit. So if we have a short confirmation here, we need to target the low. But if at the same time our return to zone is extremely good, meaning we only have liquidity, right? We only have liquidity and no demand, what is going to hold price up? And at the same time, we know that markets love to move from liquidity to liquidity. And you can see right here, the range high got deviated twice, meaning the liquidity at the highs has been taken. Now we can have that rotation down to the range low, which is where the next obvious liquidity point will be. So that's how we can use liquidity in another way. Meaning, hey, we know we can short right here, but just because we only see liquidity here, it will be a very fast and easy move down, which is amazing if we are short. Okay, it's amazing if we were short, if there's nothing that's going to hold price up. And right here, there's nothing holding price up because there's no demand and there are just lows, which consist of stop losses that will cause a snowball effect and a cascade down. And the same goes for a Model 2 TCT schematic accumulation, okay? Let's say we get the buy confirmation right here. Right here we can buy. Oh, I don't know why the pen is there. But let's say right here we get that buy confirmation, okay? We need to target our range high. But if at the same time there is no supply above us and it's just trendline liquidity, well, that's going to be very easy to rotate back up, right? That's going to be very easy to rotate back up because we just took all the liquidity at the lows. We know markets love to move from liquidity to liquidity, and at the same time, there will be nothing to hold price up. Nothing, okay? Because once that high gets taken and there's no supply backing it up, because otherwise you don't have a good trend line of liquidity, right? And that high gets taken, that will cause that buy order, spiking price higher, which will trigger the other buy order, and then you just have a spike, 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 and you have that snowball effect of actually going uphill, okay? So that's all the theory behind liquidity, right? And understanding it and how we can use it in our advantage of knowing what the market maker is doing. Because in this situation, scenario 1, we can see that the range high gets taken over and over again. Meaning they're taking the liquidity from the highs over and over again. That is buy-side liquidity. Meaning they are probably filling shorts. And especially if price is coming up, leaving this liquidity curve, and we know markets love to move from liquidity to liquidity, once we see price taking that high over and over again, right, not breaking it, using our DL2, we'll know that, hey, okay, all buy-side liquidity is going to get taken. Now we can have a rotation back down to sell-side liquidity. And that is exactly why I'm so confident in BTC right now on the macro scale. Like right now, BTC on the macro scale is the perfect example of liquidity and what the market makers are doing, okay? Because if we look at this range, right, if we look at this range, how did this range start? We were trending up very aggressively. We have a high and we have a low. That's our range high, that's our range low. Okay? Range high, range low. What has price been doing ever since? Right here we took the range low. We didn't take the range high, we took the range low. Meaning we grabbed the sell side liquidity from that low. Underneath that low, there were stop losses. When those stop losses gets hit, that triggers a sell order, making the market maker able to buy. And I'm talking tens and hundreds of millions of dollars, okay? From there, we deviate the low yet again, right here. From there, we deviate the low yet again, right here. And again, right here. So all these lows are just liquidity grabs, right? Liquidity grab 1, liquidity grab 2, liquidity grab 3, liquidity grab 4. Boom. All while every deviation stayed in the DL2, right? Right here we see our margin. Boom. This first deviation stayed in it. We extend it right here. This deviation stayed in it. This deviation stayed in it. And then again here, this deviation stayed in it, right? So we're just deviating the low over and over and over again. Okay, over and over and over. While guess what, guys? Look how we're coming down. That's our range high. This is one high. This is one high. That's a high. That's a high. You see what I'm doing here? Each high is lower than the previous high, meaning we have a curvature of liquidity above. And if that first high gets taken, that causes what causes that, guys? A buy trigger, because it's buy side liquidity, because the people that shorted, making price go down, okay, have to stop loss above that high on a macro scale. So if if I ask you what are the market makers doing right here, they're filling long positions. And the move up is going to be extremely easy because there's nothing to hold price down from a supply perspective. And we just have highs. And we have liquidity and liquidity and more liquidity. Right? And you can even confirm this by looking at heat maps. Heat maps are a tool where you can see where the liquidity is. Well, I don't need heat maps and you don't need heat maps because you can see it by using the TA that I'm presenting right here, right? And it works on every time frame. This is just a macro time frame. That's why I'm absolutely not worried that, we will never visit that high. Because if the intention of the market maker was to dump price into new bear market lows, meaning it will have to fill $1 billion of short positions, if that's his intention, to dump price, he's going to calculate, okay, I need 1 billion in short positions. What will he do if he wants to fill 1 billion? Well, he knows all these highs have buy-side liquidity. Maybe this high has 100 million, that high has 200 million, 300 million, 500 million. So if price can come above that high and will spike up, that will cause 1 billion in buy orders. So he can sell 1 billion to dump price. But we're doing the exact opposite. He's filling 1 billion in buys by taking those lows because those lows cause sell orders. When he wants to buy, he needs someone selling to him. That's why this range is going to break to the upside. And it's not happening now. And you can confirm this if you're watching the mentorship later on, right? You're watching the mentorship and you're finding it in 2025. You better see how this range ended up turning out. Because I'm betting you with my life savings that on a macro time frame, this range is going to break towards the upside and it's not going to surpass the DL2 of the range low. Okay? But it works on any time frame. For example, literally today, this is a scalp you could have taken today on BTC. Why? What was price doing? We were trending up. Okay, we were trending up. So right here, this is our range starting point. Okay? Let's just delete that range. Let's delete this. Let's delete all of this. Okay? We were trending up. In an uptrend, we pull our range from high to low. And we're going to use our DL2. Okay? Range high to low. We exceed the range, we come back inside. Was this a range? Was this a break of structure, guys? No, because we stayed in the DL limit. Okay? So we extended now. We extended now. Price came down, did not take that low. Higher low ever so slightly. Okay? Price came back inside the range. We range for a bit more. We deviate the high again. Is this a break? Nay. No. Because we did not close above our DL2. We need to close. A wick is completely fine, guys. You need a close above it for it to be invalidated. So what can we see? What can we see? Price is taking the high over and over again. Grabbing all buy-side liquidity, right? Grabbing all buy-side liquidity. But at the same time, we have a low right here. We have a higher low. And we have a higher low. And we have a higher low. And we have a higher low. So price is taking the high, but it's not taking the low. So we're taking all buy-side liquidity and we're leaving sell-side liquidity here. So what is the market maker doing, guys? Maybe the retail person is trying to long each higher low, thinking there's a break of structure. What the market maker is doing is he's filling his short positions. So right here, he filled short position 1. On the deviation, he filled more shorts. And on this deviation, he filled his final shorts, right? This is a TCT Model 1 schematic for the people interested. At the same time, we're not taking the low. We're not taking the low. So what do we have, guys? We're taking the high. We're taking all buy-side liquidity. We know markets love to move from liquidity to liquidity. So if all buy-side liquidity has been taken over and over again, and we're leaving sell-side liquidity behind, price will come towards that sell-side liquidity, okay? Once the confirmations are met, which will be taught in the TCT schematic strategy section, okay? And now you have to ask yourself, why was this move down so aggressively? Why was this move down so aggressive right here? Well, that has to do with the return to zone. I told you guys that the moment this low gets taken, a stop loss will get hit, causing a sell order, okay? Because people longed, put their stop loss below the low. When you long and your stop loss gets hit, that causes a sell order. You sell back to the markets. That caused a spike down towards that low, where the next stop loss location was. And then that caused a spike down to this low, where the next stop loss location was. And that caused a spike to this low, where the most stop loss locations were, because that was actually the range low, right? So this is not an aggressive move down because people are selling. You don't have people shorting right here. You just have stop losses getting hit right here, which cause a massive snowball effect down. Just a douche. That's how that works. That's also, guys, understanding liquidity from this POV, where we have, all buy-side liquidity getting taken over and over again with 2 range deviations, and then getting acceptance back inside, boom, reversal. And we had an amazing return to zone, no demand, so the move down will be easy, which adds that extra bit of confluence and confirmation to the trade, okay? But just by understanding this was also how I managed to call the PO3 on BTC. You don't need to understand what the PO3 is yet, but right here we have a low, we have a high, and we have a higher low for a higher high. This was a break of structure, okay? While this is a break of structure, while you can see it with your own eyes very clearly, but also if you use the DL2 to confirm it, did we close above our DL limit? Yes, we did, very convincingly, okay? Very convincingly. So yes, that is a market structure break. Let's keep that in there. Let's keep that in there. We have a low, high, higher low, higher high. Okay. Was this a market structure break? Let's put it correctly. Was this a market structure break, guys? No. Why? This is a range. We can use our DL2. Okay, we can use our DL2 and look at that. We never closed above our TL2. Never confirming a break. At the same time, we had this 6-hour order block, which you should also know now, right at that DL limit line where we could reject from. Okay? So instead of thinking, hey, I'm going to long the higher low for the higher high, which is what everything and everyone tried to do online. I saw it with my own eyes. You now can change your perspective of like, hey, this was a range. This was a range. This right here is simply just a deviation and our manipulation above the range high, giving the market maker the opportunity to fill his short positions because we came above that range high, which was buy-side liquidity, right? At the same time, people try to long the breakout and long the higher low right here, thinking it's going to do like this, higher low and higher high. That's what people try to do, which will cause extra fuel to the fire. But you guys know now, the range high is taken. That gives the market maker the opportunity to fill his short positions because the range high was buy-side liquidity. So now he can fill his short positions. If we get acceptance back inside the range, we can have a rotation down. Because look at it, guys. Look at this. What did we have inside of the range? We have highs, or we have lows. Then we have a higher low, and a higher low, and a higher low, and a higher low, and a higher low. You see all these lows being higher? Meaning all the people that long inside of the range put their stop loss below the low, which is sell-side liquidity. So there's nothing to hold price up. Absolutely nothing to hold price up. This is how I managed to call this, guys, just by understanding liquidity. So we use the DL2 to see if it can be a deviation. And when it can be a deviation, you switch your mindset to, hey, buy-side liquidity has been taken. We have lots of sell-side liquidity below. Markets love to move from liquidity to liquidity. So if we get acceptance back inside the range, we can have the rotation down, which happened right here very aggressively because this is that cascade down, that snowball effect I've been talking about. That's literally just this, guys. What you see right now on my chart, is literally what we discussed. Right here. Right here, grab all buy-side liquidity, deviation. Retail will try to long the higher low, thinking it is a break of structure, but it's a fake break. We move from liquidity to liquidity. That's literally this right here. That sketch is literally what you see in front of you, okay? So this shit works, guys. Understanding liquidity, you will know what they are doing. Because if the market maker wants to dump price, he cannot just dump price randomly. He has to make price act in this way in order to dump it. Otherwise, he can't. He can't just randomly dump it because he needs to fill his positions. So you will always see what they are doing. They are not doing it sneakily. They cannot do it in a sneaky way because they need to fill massive positions. And in order to fill massive positions, they have to make price act in a certain way by taking either all buy-side liquidity or taking all sell-side liquidity. And we can notice that on the chart. And that way you will always be on the right side. And you will take others people's liquidity and you won't be liquidity. Okay? Understanding this is key. It's absolutely key. Okay? Understanding this right here, if you understand this, the TCT strategy will make so much sense in the next lectures because it's based around what you're seeing in front of you right now. Okay? And it's so effective, guys. Understand this. Study this lecture over and over again. Look at the markets. Play around. Draw your ranges. Look at the DL2. Is it a deviation or is it not? Right? Do we have a return to zone? Do we not? Do we have trendline liquidity or not? What is price most likely to do next? Thinking from a market maker perspective. I want you to think as if you are the market maker. Think, if I had 100 million and I need 100 million to be fulfilled in order to move price, where will I do and what will I make price do in order for that to be fulfilled? AKA, hey, maybe I would take out the range high, making people think we have a break of structure, making people think into long and higher low. But at the same time, when I grab that range high, I just fill massive shorts and I absorb all their long orders and I just dump price on them because that's what I can do. Markets only move in your desired direction if the market maker decides to, because they are the only one that can move price. And by trading with them, you will always be on the right side of the market. So understand this, study this, combine it with supply and demand above your range high, below your range low, combine all of it, play around, practice, and then go into the TCT strategies because it will make so much sense now. Now understanding liquidity, combined with your ranges and how to pull them and the range deviations, right? And the supply and demand, it will all make so much sense. So this was the last. My mic's still working. Oh yeah, we're all good. Okay, thought we had an error real quick. Guys, this is the last lecture of the basics, the foundation, the things you need to understand to also trade TCT schematics, okay? Now we're going to get into the juicy stuff. So if you have made it until here, I'm proud of you. Low-key is not even that hard. Like, I'm giving out a free mentorship with the best value and the best information that's out there, which will literally make you profitable for free. So if you don't have the timestamp to watch all the lectures, you literally do not deserve to make any money. But for the people that are listening to it right now, I cannot wait to teach you TCT schematics. Take this video in, absorb all the information. Don't go from vid to vid immediately. Like let it cool off. Let it settle a bit in the mind. And then I'll see you guys in the next lecture where we will be talking about Wyckoff.